What's up everyone, it's Scotty with MoneyVest. In today's video, we are going to be talking about Home Depot, and I will be doing a lot of stock analysis on a lot of these retailers because it is a pretty big retail week. Also, we've got inflation numbers coming out on Tuesday and on Wednesday as well. So hope you guys enjoy this video and find it helpful. In our future videos, we will be talking about Target, Alibaba, Walmart, and of course, today's video is going to be on Home Depot. Make sure that you drop a like and subscribe to the channel if you haven't already. I would really appreciate it. And links to our Discord and Patreon is going to be down below in the comments and in the description as well. You do get access to a lot of members-only private videos and can unlock and access a lot of Excel spreadsheets, and these are spreadsheets related to our intrinsic value. So whatever analysis that we do here, the intrinsic value is going to be plugged into our spreadsheet. That's going to be easily accessible for you, and you get access to our S&P 500 valuation, volatility cheat sheets, and a lot of other really important data sets and spreadsheets as well. And of course, you get access to our Discord channels, over 20 plus Discord channels, including trade alerts, options alerts, trade ideas, and market updates as well. So links going to be down below, and we'd love to have you on board. So let's just dive right into Home Depot. And Home Depot has been one of the strongest companies when it comes to home improvement and repair. As you can see that the revenue has been consistently growing. So this right here is the overall bar chart. You can see that it's been growing from $78.8 billion to now well over $154 billion in the trailing 12 months. So that's over 100% increase in the last 10 years. Gross profit, same exact thing. Very, very nice, consistent growth from 27 billion to well over $52 billion. So that is once again a little bit over 100% growth on a year-over-year basis, not to mention operating income also moving in the right direction from 9.1 billion to well over $24 billion. So that is over 130% growth. So that is significant amount of operating leverage that's kicking in for the company. In other words, they're becoming more and more efficient over time, and that's exactly what we want to see, margins expanding. Take a look at net income. I mean, this is just absolutely phenomenal, right? This is exactly what consistency looks like, because when a company is able to grow so well in terms of their bottom line and profitability, where every single year they're posting some very good numbers, you know, $5.8 billion to well over $17 billion in bottom line profit. That is a very good growth. That's over a 200% increase in the last 10 years or so. Shares outstanding have been going down from 1.4 billion to now sitting at just about 1 billion shares outstanding. That's a very, very phenomenal share buyback program. And not to mention EBITDA, that's your earnings before interest, taxes, depreciation, going from 11 billion to well over 26 billion dollars for the company as well. This right here is going to be those earnings expectations for tomorrow. So November 14th, before the market opens, is when they're expected to report earnings. They have seen 13 upgrades in the last 90 days and 6 downgrades from analysts. Revenue expectations is sort of 37 billion, with EPS expected at just over $3.70 per share. And we're also looking at some decent profitability margins at 33% profit margins, with net margins of sitting just over 10.5%. And return on common equity, assets, and capital also really, really good. And net income per employee has gone up to over $34,000. That's up from $30,000, which was on a trailing 5-year basis, right? So 5-year average $30,000, trailing 12-month over $34,000. So the company is generating more profit per employee, a very, very good efficiency metric, not to mention very strong return on capital, assets, and equity. Pretty good lever free cash flow margins, net margins, and gross profit as well. So what we have on our hands is a company that is growing revenues, growing profitability, expanding margins, doing share buybacks, and also very, very efficient. However, the balance sheet is obviously a bit of a concern because it is in a business of products and hardware. And, it's not like a software company with high margins and a lot of free cash flow. Even though it is profitable with some good cash flow, the company does have $2.8 billion of cash and almost $50 billion worth of debt. So total net debt is sitting at 46.6 billion. That's positive. We want this number to be negative, and current ratio is 1.3, and quick ratio is 0.27 when you take inventories out. We want this number, both of these numbers, ideally to be over 1, ideally to be over 2, but at least over 1. But quick ratio, meaning that the company does have a lot of inventory on the balance sheet that make up majority of their assets, and as a result, if you take those out, quick ratio is pretty poor at 0.27. Debt to free cash flow, we want this number to be under 3. Right now, it's sitting at 5.89. So balance sheet's a little bit of a concern for the company. However, the valuation, I would argue, is quite reasonable for a company that is growing every single year. So we're looking at 18 to 20 times price to earnings multiple, with a price to sales sitting at just under 2, enterprise value to EBITDA around 12 to 13 times, and price to cash flow sitting at just under 15 at the moment, with a dividend yield of 2.8%. So valuations, I would argue, is okay. Obviously not very cheap, quote unquote cheap or undervalued by any means, but also not super expensive or crazy either. So if you come over to Home Depot's price action, what you'll notice is that obviously the price has been selling off from $336. It is down a little bit over 15%. We have done some extensive analysis on this company in the past. So from highs of well over December 2021, the stock is still down over 28%. And more recently, though, it's been consolidating sideways. So this right here has been a lot of the range within which it's been trading. So this is the overall consolidation pattern for Home Depot, with a massive amount of resistance sitting at 334 and a lot of demand and support sitting at 265. So if you jump over to our calculations, and if we basically look at the forecast, the earnings forecast for Home Depot, so if you come down a little bit, look at earnings and annual basis, they're expected to grow from, let's say, $15.12 this year to almost $19 by 2026. So if you plug in 15.12 over here, and then we plug in $19 by the year 2027, I believe was that, 2026, we are looking at a growth rate of just under 8% for the business, right? 8% is going to be that growth rate for the company. Trailing 12-month profitability here, we're looking at $16.2 billion, 16,233. So let's just plug in $17 billion for the company here into our models. So we're going to come here, Home Depot, 17 is what we're going to put in. And when we apply, let's say, a growth rate of 10%, right? 10% I think is quite reasonable, even though the analysts are pricing in, I believe, a little bit under 8%. So if we assume for a 10% growth rate over the next, 5 years, and a PE multiple, right now, as we know, it's trading at 17, 18 times price to earnings multiple. If we assume for, let's say, a 16 times price to earnings multiple with a 12% discount rate, maybe we can go down to 10% because the company does pay a dividend of 2%, a little over 2%, margin of safety of 10%, and share dilution of, let's say, -1, because the company has been buying back a lot of shares in the past. We get down to an intrinsic value of about $257, and right now it's trading at $291, which means 12% potential decline needed in order for the stock to be trading at its intrinsic value, which is actually going to be surprisingly inside this green rectangle as you see over here, right? That's a very, very important area of support. That's exactly where we have bounced off of in the past. So you'll notice that inside this green rectangle, at least in my opinion, would mean that Home Depot would be at a very good sort of value trading at those prices. Now, a couple concerns I want to highlight is the actual balance sheet. Balance sheet's a little bit of a concern for the company, as we've already mentioned. Lots of debt with little to no cash. Quick ratio is pretty poor because the company does have more inventory on the balance sheet, and debt to free cash flow is also well over 5. So that is something to keep in mind. And the company also depends very much on the quality of the housing market in the U.S. We know that building permits and housing starts, new home sales have all been declining over the last several months because of higher mortgage rates. As mortgage rates are higher, we're not seeing as much construction, we're not seeing as much buying activity, and as a result, the demand for Home Depot is strictly on the basis of home improvement and repairs and construction and all those types of things, right, within the housing market. So if that continues to slow down, it's possible that the growth rate may not be as high as 10%. We may have to come down a little bit on the growth rate. So if you take a look at the sensitivity grid, if I come down to, let's say, 8% or 6%, now the intrinsic value sits somewhere between 213 and 234. So that's really going to be the range if we assume a lower growth rate for Home Depot. But for now, I'm happy with a 10% growth rate and a 16 times price earnings multiple, where I wouldn't mind sort of considering Home Depot from a fundamental long-term perspective, and the dividend yield is also decent at almost 3%. In fact, we could even go with a lower discount rate at closer to 9% because the company does pay a pretty reasonable dividend of just under 3%. But this right here is going to be that level, right? So somewhere between 248 and 265 is where I could see a very strong support for Home Depot, and also kind of in line with that intrinsic value on a conservative basis for this company. And our resistance is going to stay put at 334, and right now we're just consolidating sideways in that range. So let me know your thoughts down in the comment section below, and what do you think about Home Depot, and where do you see this company going over the long term? I did have a few more screenshots to share for this company, so let me see if I can bring those up. Yes, so this right here was the forecast. I don't know why it did not load up in the first try, but this right here is the earnings forecast of $15.15 all the way to $27.33 is going to be that forecast. If you plug in some of these numbers, so 27.33, if you plug in this number here, 27.33 by the year 2033, so let's put that in 2023, 15.15, we're looking at a 6% growth rate, right? So even lower than what we assumed for in our analysis. This right here is going to be the free cash flow growth. So pretty decent growth, right? So going from about $6 billion to well over 12.7, almost 14 billion. And then this right here is going to be the earnings tomorrow, November 14th, at around 9 a.m. Eastern is when they are going to be reporting. And this right here is going to be the guidance from the company. So they are expected to decline in revenues by about 2 to 5%, and diluted earnings per share also expected to decline between 7 and 13%, just given the constraints with the higher mortgage rates. This is building permits, as you can see, that they have been coming down since 2022 because of higher rates, and this is new home sales, which also have been declining. They're on the rise once again here, but bottom line is that we're still lower than where we were in 2021, 2022, given how interest rates have gone up so much, and as a result, Home Depot is also struggling a little bit because of higher interest rates. So as always, make sure that you drop a like, subscribe to the channel, members only videos, and Excel spreadsheets and Discord access. Everything's going to be available with the link down below. We'd love to have you on board. 16% annual discount that's available till the end of this month. And as always, happy investing, and I'll see you all in the next video.